I think we can start off this course with the assumption that the markets for equity are not perfectly efficient. So what does it take for me to beat the market? What does it take for security analysis or security valuation to make sense? For security valuation to make sense, I need three things. The first thing I need is for inefficiencies to exist. All right, and I think we can safely say, given that inefficiencies, given the fact that people would stop doing research if markets were perfectly efficient, that obviously, I think we're pretty good on this one, right? I think there have to be inefficiencies out there. The second thing I have to be able to do is I have to be able to identify the inefficiencies. All right, so I have to be able to identify the inefficiencies. So, and this is, I think this is the problem. I think this is a lot of times what, finance academics are really talking about when they say, well, it should be very hard to identify these inefficiencies. I have to ask myself, what do I know in Cincinnati, Ohio that isn't priced into the market? What information that everybody has can I interpret in a different way? What's my comparative advantage to be able to identify these mispriced stocks to get a higher return? So I think this is a hard thing. Then the third thing that we also need is that the markets must correct, right? So and we can think about situations where we wonder about this, right? So these inefficiencies have to exist. I need to identify them. But if the market continues to be inefficient, it doesn't react, it doesn't reprice, I can be right that the stock is mispriced and that it's undervalued. But if the market doesn't correct in a timely manner, I still don't profit from the security analysis, the security valuation work, and so on. So when we start to look at trying to identify stocks that are mispriced, try to do what I call active management. Active management is the concept of trying to actively pick stocks, actively pick sectors that we think are going to outperform others. I need to really keep these things in mind. What is my, and especially these second and third, what is my comparative advantage, and when will markets correct? So right now there's a the FANG stocks, the four big Facebook, Amazon, Netflix, and Google have just taken off like crazy, and I might think that those are overpriced. But if I thought they were overpriced over this period, and they keep and I shorted them, they keep going up and up and up. In other words, the markets don't correct. So even if I was right that they're overpriced, but the market doesn't correct, I could really lose a lot of money shorting those in the process. So who knows? Are they properly priced? I don't know. That remains to be seen. But this is a concept we really need to keep in mind throughout the course. And then that leads to a question, personally, professionally, and so on, this concept of, do I want to do active management or passive management? So active management, I'm actually, identifying stocks, identifying sectors, and so on, trying to outperform a benchmark, or typically a benchmark or something. Passive management, I just say, well, look, I'm going to be satisfied that markets are priced fair enough that if I invest in index, I will get a fair return. And so one question I always like to ask is, if the price of Walmart today, is $83, what do I expect the price to be 1 year from today? 1 year from today. And we can think about that, and this can be a challenging question for finance majors I've found over time. And if we think about the price 1 year from today, and we think about our finance training we've had so far, well, if markets are efficient and Walmart is fairly priced, the return that I should get would be essentially what the capital asset pricing model says. I would take the $83 times 1 plus the capital asset pricing model, which would be determined essentially by Walmart's beta. So we know that Walmart is a fairly low risk. Its beta may be 0.5. So whatever I assume for a risk-free rate plus an expected return on the market minus risk-free rate times 0.5, my expected return for Walmart will be 83 times whatever my expected return for Walmart over the year. So what I'm essentially trying to identify is, if I'm analyzing Walmart from a security valuation perspective, I'm trying to decide, is 83 a fair price, or do I expect Walmart to grow more than the capital asset pricing model? Do I expect the return a year, or the price a year from today, to be more than 83 times 1 plus the capital asset pricing model? And essentially, if it's mispriced now, as soon as the market corrects, that's when I'm going to benefit from the security valuation.